Hello investors, I'm Stuart Kruse and welcome to Kruse Asset Management's Chart of the Day. It's the first week of October preceding the presidential election by 28 days. As we've been following, the S&P 500 has had a stellar track record of predicting future presidential elections. When the market's up, tends to be the incumbent that wins. When the market is down, tends to be the incumbent that loses. And also, as we suggested, September was traditionally the weakest month, and this year was no different. It was down 4.6%. The Qs were down over 7%, and in fact, quite a few other categories were down, like gold, and even the bonds were down. So cryptocurrency was down, so there was no real place to hide. So what does that mean for the future returns of the market? Well, JP Morgan, our friends at JP Morgan, puts out a quarterly guide to the markets that I like to peruse. Some of these charts in there are really great charts. And here is one of my favorites on page 6. And you hear me talking about PE ratios quite a bit. That's price to earnings. It basically is a measure of how much the market is willing to pay for a dollar of earnings. So PE ratios and equity returns. So we're looking on the left-hand chart here. And what this says is PE ratios, as PE ratios go out to the right, that's more expensive. What are the future one-year returns? And they plotted these all out. So what this dot means right here is when there was a PE ratio, probably around 22, that dot showed a forward one-year return of around, let's call that 8%. Okay? So here we are at 21.5 on this line. And if you said, hey, what were my future returns? Well, we had some positive returns up here above 20%. Those are great annualized returns. The one up here at 40%, phenomenal. And then we also had a cluster of them down here below, negative 10, negative 20, 22%. But to me, if I were to look at this chart and say, is there a real pattern? Because this orange line is a regression of this data. And while the regression does show that it goes down and to the right, which is what we might expect, as PE ratios get more expensive, we should expect less returns. As you're willing to pay less for a dollar of earnings, or you're actually paying less for a dollar of earnings, your future returns should be better. That's Warren Buffett's strategy. It's worked really well for him. So here we are at 21.5, and what this regression would say is, returns aren't so great. But in any 1 year, it looks like we could get really bad returns or some really great returns, right? Now this R squared down here, what this says is that's the relationship that is explained by this ratio. A 100 R squared, 100% would be a perfect explanation. A 0 means there's no explanation or correlation at all. So this 8% basically means there's very little correlation to this chart. So what this says, for PE and one-year returns has almost no predictability. So why am I showing you this? Who cares then, right? If it's not helpful, if we can't use math to predict our future earnings, then why even look at it? Well, that's what I'd say. But let's look over at this chart on the right, because the data is exactly the same. It is the same data. The only difference here is instead of the forward PEs and subsequent one-year returns, this is subsequent 5-year annualized returns. So what that says is, what are the 5-year returns when we have a PE like this? And now you can see this chart is much more defined, much more clustered. Instead of 8% productivity or explainability, it's more like 44%. And you can just eyeball this and see that there is a much more defined pattern here. And if we look at this 21.5% return, or 21.5% or 21.5 PE ratio, that regression number sits right on the 0 axis. That means no future returns or net returns for the S&P over the next 5 years. None. That basically means we're not going to get any good returns from the stock market. So yes, could you have some 5-year returns that on average give you something? Yes, on the high end, it looks like maybe we got just under 10%. So that's below market expectations. On the low end, a 5-year period, we're actually negative, okay? When you get off in a little higher, there has never been a case where you've had high PEs and good 5-year returns. And conversely, when you have low PEs in the marketplace, never been a case where we haven't had pretty robust returns. So here we are on the high end of this chart which puts us on the low end of the market returns. Now, you say, hey, what do we do? Because bond interest rates are at zero, so I can't expect many returns from bonds. If you're telling me the stock market isn't going to give me any returns, then maybe I should just put it into gold or cryptocurrencies. And I guess that is actually part of a diversified strategy that we can probably talk about later. And you should probably have some assets in both gold and crypto. But there are other ways where we can get returns from the equity market, even if we're not investing in the S&P 500. And if you want to find out what some of those ways are, go ahead and schedule a meeting with me below, and I'll show you some of the math and the data that we worked out that can get you returns without putting you in the S&P 500 and without putting you at risk. Okay, so this is Stuart Kruse with Kruse Asset Management telling you and reminding you, as always, to invest with the odds in your favor.